Good morning. It's been a while. Welcome back to Good Returns is what we're calling it. My name is Garrett.
I'm Matt.
You introduce yourself.
Yeah, I'm Matt. We're the founders of Momentum Wealth Management.
Yep. And this podcast is a deep dive companion to our weekly note. This is an email that we send out to clients, just highlighting the week in review, some headline takeaways, a little bit about the market, and then we'll deep dive into sort of a financial planning topic that may have come up in the past week with client conversations and things like that.
Yeah, absolutely. And if you're not getting the email and you'd like to get it, we can accommodate you. Just go to momentumwealth.us, shoot us an email, and we'll be more than happy to get you on the email list. But yeah, it's pretty important. The weekly notes, really very market specific, but it provides some color and some context to a lot of the headlines, kind of things that are going on. And it's just always important, regardless of your investment journey or where you're at in your retirement plan, to just kind of pay attention to things and have some context, because it helps you be able to go through the ups and the downs and the changes of the market.
The sideways.
The sideways, the ups, the downs, the sideways, with a much higher degree of confidence. And that ultimately is how you win in the game of investing, is having a good plan, having confidence in it, and letting time work its magic for you, ultimately, at the end of the day. So, yeah.
Very true. Couldn't have said it better myself. I'll let you get into the disclaimer. We bring that back. You like to do that so much.
Yes, this is our mandatory disclaimer. This show, of course, is for educational and illustrative purposes. We're sharing our perspective. It is not specific financial, tax, or legal advice for your situation. Every household is different, so please consult with a professional, with a trusted advisor like ourselves. That's always going to help you make better decisions in general. We believe that using professionals, whether it be tax planners or financial advisors, real estate professionals, is always a great thing to do. And if you don't have a trusted advisor, we'll be more than happy to have a free consultation with you. MomentumWealth.us. And you may hear the occasional train horn.
We're in an old train station, so it comes with the par for the course.
1890, 1900, something like that.
Yeah, we just can't get away from buildings near train stations.
Yeah,
for whatever reason, it's just one of those things.
For our wonderful Monroe and West Monroe, Louisiana clients, you know exactly what we're talking about. With one of our first office renovations we did was probably 15. It was probably outside of code, to be honest with you, how close it was.
To the tracks. Yeah,
15 feet, maybe.
Yeah,
it was
close.
Very close. So it was like an earthquake, three times a day when the train would go by. But
yeah,
well, let's get into the kind of the numbers and some things that are going on and go from there. So, yeah, scoreboard for the week ending February 27th. Kind of really, would you call it a round trip? Kind of a
we had a sell off at the beginning of the week due to the tariff type situation. We're still, for some reason, that's still a thing where we have the markets react to tariffs. And then we kind of level off by the end of the week. I'm not sure, we're recording this in the morning. I guess I should look to see what the market's doing. We're down a little bit today. But yeah, it kind of, you get those reactions to something like tariffs. In this case, we'll talk about it in a minute, but in this case, the Supreme Court ruling on Trump's tariffs, how the market reacts to that, so forth and so on. But it was sort of a narrow gap. You got the NASDAQ, S&P, and equal weight S&P, actually. Russell 2000 and the Dow were all basically flat to maybe a little bit lower. Action here was sort of in the defensive plays. You got your consumer staples, your utilities, and industrials and consumer discretionary lagged a little bit. And then we saw gold, which was interesting.
Yeah. Up
3%-ish this week.
We'll talk a little bit more about gold and some interesting things about gold here in a minute as well.
Huge weekly move.
Yeah.
And then you got the 10-year Treasury yield fell to around 4%, which is the lowest level since November, and we'll talk about that a little bit as well.
Yeah, we are seeing rates trend down. And, it's interesting. It provides perspective as you build, as you study these things and as you analyze the data week after week, day after day, month after month, year after year, so forth and so on. You start to see how, which narratives are true as to what's driving the market, what's more headline reaction. And if you're new to investing, you can't really look at these short-term moves to glean any type of knowledge or confidence as to what way anything is going. You mentioned the tariff trade. That was really kind of driving headlines on Monday. a lot of times these short-term reactions are really either opportunistic. So if we're in a period of the business cycle where money supply is limited, the business cycle goes up and down, money supply increases, it decreases as a function of the banking system, of the Federal Reserve, of what the Treasury is doing with the government debt and how it's refinancing it. And you also have what's called algorithmic trading, which is very simply these algorithms can pick up on a lot of noise of what's happening. What are people concerned about? What are they talking about? And if it's reaching a crescendo, such as a Supreme Court decision on a well-known topic, then either one way or the other, they can push trades towards the long, towards buys, or towards the short, towards sales. At the end of the day, it really is noise concerning, I believe, the tariff discussion, because nothing really changed. I think it was, within one day it was back to,
well, it's semantic.
It's a legal, do we do it this way or do we do it that way? And that's why I think we went through that round trip. And you mentioned equal weight, very interesting. We have seen, again, short-term data always has to be validated by like long-term outcomes. But we are seeing more and more instances of the S&P equal weight and of your mid caps outperforming. Yesterday was a day of that. It's very interesting to watch that. So we are.
Why would that be? Let's provide a little color to that.
Okay, so from my perspective, I think it has to do with the business cycle actually expanding. And that's been validated by the ISM index, which is the manufacturing index turning above 50, or what you could very simply look at as turning positive for the first time in quite a while. And I think that is broadening out the bull market. The second thing is I think that you really have this bifurcated performance in the market between your Mag 7, your hyperscalers, your ones really driving the actual AI infrastructure, and businesses that are beginning to actually use those tools to increase their profits, reduce their operational expenditure. And that is really the most interesting aspect of AI this year, is going to be how many of these smaller companies begin to blow out their earnings to the upside by actually using AI in a productive manner. So that could be some of the things that are underlying, because you think the vast overwhelming majority of the economy is businesses with a market cap less than $100 billion, which is your mid cap to your small cap, which small cap used to be, what, 10 billion or less. Now it's probably 20 billion or less. And those guys have, an enormous amount of inefficiencies that can be solved with AI. And that could be, we could be seeing the beginning of that, of these smaller companies actually saying, okay, it's the cool tools that these other guys have built, like I can actually use that to either reduce headcount, unfortunately, or improve profitability, make more an efficient use of the headcount you currently have. We just have to see how that plays out. But at the end of the day, it's a numbers game. More efficiency, lower cost, revenue, earnings should go to the upside. And I think we're beginning to see that. We saw that with Block today, which I think their market cap was not very. Actually, I'm going to pull this up because this is.
Yeah, I mean, the end-all be-all of the equal weight versus the S&P is that, the S&P is a weighted index. It's market cap weighted. And so you can have companies within the S&P 500 that are more represented than other companies because their weighting is larger. So what the equal weight S&P does is just makes all of those companies in the S&P 500, which is a little more than 500 companies, but it makes them equal weighted. And so when you see outperformance of equal weighted index over the weighted index, the market cap weighted index, what you're looking at really is more market participants making that even weighted index rise higher than the overweighted index to tech in this instance. It's not always that way, but it has been for some time. So in my mind, that's more broad participation, which is actually good. That's what you want to see in a solid bull market, is you want to see more people participating.
Yeah,
so
and you have to look too at who are the established players. And every time there's been a very large disruption because of technology, those established players are no longer kind of the big kids on the block. They get disintermediated. And we saw this happen with, if you look at the largest makeup of the S&P 500, say 15 years ago, 20 years ago, it was probably your oil and gas. It was probably your pharmaceuticals, maybe some of your industrials and defense companies. Now it's tech. It's going to be very interesting to see. And this is why it's very, very good to pay very close attention to how you're allocated, because there are going to be the established players that are dominating today that will be disintermediated with this technology. And so you want to have exposure, and you want to have a true diversification. You want to have a strategy, and sometimes leaning more towards the weighted index makes sense, and sometimes meaning being more equal weighted makes a lot more sense when you're thinking tactically over a certain period of time. But the equal weight always, we believe and have long believed, gives you a better representation long term as to what your success of actually hitting your compounded rate of return that you need for your retirement. And some people need less of a compounded rate than others. So it doesn't, you don't need to chase what you don't need. First of all, you want to always try to exceed those expectations, because that's great. It makes number go up, makes you smile. But you want to first hit what you need, and the equal weight is always a great tool to help kind of measure that out and to see how realistic it is to reach those goals. But very, very, very interesting. Very interesting.
Yeah, I think that's right. We can hop into the meat of the show, which is going to be, what we're looking at. The weekly takeaways is kind of what we're headlining them. But so we'll talk about the GDP kind of. Let's talk about the headline number being 1.4% for the last quarter compared to 4.4 we saw in Q3. Is there some context there that's not just destruction of growth from one quarter to the next?
So GDP in Q3, say that 5 times fast. In Q3 was pretty good. Q4 was definitely muted. Really, that extended government shutdown essentially stole growth from Q4 numbers. Anytime you have changes occurring with government spending, you're going to have short-term disruptions. The BEA estimated the reduction in the services subtracted probably 1 percentage point from real GDP growth. We really don't know. Economists, looking back, will do a pretty good job of kind of assessing that. But the trend appears to be up. And I think that as GDP is very interesting, and we want to pay close attention to it. And the media pays very close attention to it. And it's right now is a good barometer. I'm not sure 5 to 10 years from now if it's calculated the same way it is now, where it's actually going to be a helpful barometer. And I was listening to some fairly successful tech guys talking about GDP and artificial intelligence and really the changing landscape. And if you look at GDP, how it's calculated now, you can take 2 economists into the woods, and they can pay each other to eat pine cones. So they take one $100 bill with them. One pays one to eat a pine cone. That was delicious. And then he pays the other with the same $100 bill, and they do it 10 times. They've contributed $1,000 to GDP. Nothing productive happened, and they just passed the same money back and forth. But if you cure cancer, and that eliminates 50,000, medical jobs that treat cancer. Let's say it's breast cancer. Say we're trying to get to where, and there's a lot of really cool things happening in the cancer space to really make an impact on different types of cancers. But let's say we cure breast cancer, that could eliminate 50,000 jobs overnight. But obviously it's better for us, and it's better for society, and ultimately better for the economy that money is not spent on these treatments and the disruption it causes to people's lives. So technological changes are going to really disrupt the traditional way we look at the economy. That's years and years away, but I like to look out to that because it'll again, helps build confidence, helps build the correct perspective when you're investing for the long term. So it's going to be very interesting. Now, GDP also is affected by government spending anytime there's a change initially, but we do have to remember the government is either going to print the money, which dilutes the money supply, or they're going to take the money from the private sector one way or the other, be it through some type of tax, a tariff. Tariff is a tax, an income tax, some type of tax. So that's money out of the productive economy and then redistributed through government in a different way. So it's kind of the same money. So you have, I know the government's reduced workforce by a certain percentage. That probably weighs on GDP initially, but different economists have different opinions over, a year from that, will it have a net positive effect? To be seen. I know there's people that study this for a living, and they have some pretty well thought out, assumptions. You just have to kind of see how that pans out. But all in all, GDP is trending up. Q4 government shutdown, it did trend down.
And we're in another kind of shutdown right now, I guess.
Yeah, I think so. I heard something. Yeah, I didn't even know. It was something about partial, or I don't know.
Oh, well.
I don't know. We're never shut down here at Momentum Wealth Management. We are open 24/7, 7 days a week.
Oh, Lord, don't say that. All right, well, let's move on to the next one, which is the tariff. We talked a little bit about it already, but Supreme Court ruling, they struck down the administration's broad tariff authority under emergency powers, and you saw the market. We loved it for like 10 minutes, but then the administration used a different legal framework, and they slapped a 10% tariff back on. So is this what we would refer to as maybe policy risk?
Maybe. I mean, we've been living with the tariff talk now for a decade. I mean, I kind of think we're immune to it. I mean, I think the question is, are we immune to it? I think
the market
we are,
would suggest I don't know. I mean, maybe, but it's we have this reaction, kind of this whipsaw effect every time they're brought up. Every time the term tariff is brought up on the news, you see a whipsaw in the markets. So I don't actually know if we are immune to it at this point. I think there's a lot of people that would like to think we are.
I mean, I don't know if you reduce income, all it is a sales tax. That's the way I look at it. Now,
Right.
Technically it is not, but to me it's a sales tax. Okay, the price of the good is going up because the government's taken a slice off the top, or the wholesale price. So, I think just from kind of a simple way to look at it, if we're reducing income taxes while tariffs are going up, it's kind of a wash, and it's kind of a sales tax. I know that there are legitimate ways to disagree with what I just said, and you may be right, but just looking at it from a 30,000 foot view, I think that the tariffs, I would love nothing more personally for there not to be an income tax. I think moving anything kind of that's more broadly distributed and voluntary, and goes based on your consumption. I could be wrong, and people may be perfectly right in disagreeing with me. But I tend to lean more towards it. I could be convinced, if I was king for a day, I could be, somebody could convince me, but I tend to lean more towards that. So that's why I view it that way. But I don't know. I think that the numbers that they're talking about with the new legal regime relative to what happened last year are virtually exactly the same. So it's like, we kind of have already gone through that. And
but you could say the same for the first Trump administration, because you had
I don't remember.
Similar kind of rumblings about it and kind of the same market reaction. And so it just keeps happening.
I don't
when
know.
Trump 2.0 was elected, that's the conversation that we had, was like, okay, we know he loves tariffs, so we know he's going to talk about tariffs. Are we going to be ready for that conversation when it comes up? And it turns out, we weren't, because the market in April dropped of last year. And
I don't know. I think that, to me, I think what happened in April was more, I think that was the straw that broke the camel's back. I think there was some liquidity. I think there was some excess leverage.
Yeah, I mean, multiple things could be true, but I think that anytime you have to have a catalyst. This goes back to the whole momentum, the whole idea of momentum, which is, what we have named our firm after, but this whole idea that objects in motion stay in motion until they're met by an equal and opposing force. And so something has to happen to change it. And so whether that's a conversation about tariffs, or, Trump saying, I'm going to do this, and then a few weeks later saying, no, never mind, I changed my mind, or whatever, or the liquidity issues, same kind of situation ultimately. But I don't think we are actually, I think they're just, it seems like there continues to be reactions from the market, from traders, from analysts about tariffs, even though at this point I do feel like, at least from a knowledge perspective, we kind of know what his MO is with tariffs.
Yeah, I don't know.
It's not surprising in that in that part, but the reaction every single time is a little bit surprising to me.
It could be again, thin liquidity, opportunistic trading, algorithmic, based on the headlines.
Yeah,
trying to play on emotions. I'm not sure. I do think that every every instance of, and this is why the U.S. market is so resilient. When you look back over history, there's been all kinds of changes, disruptions, and we always find a way to be more innovative, more profitable, more growth oriented. And so, I like the resiliency of it. And this kind of flows into the next point with the rate cuts.
Yep.
We used to live, the U.S. market used to really not care about what the Federal Reserve said. And I don't know exactly what got us to the point to where every Federal Reserve meeting is like the Super Bowl, or like, something where everybody's like on edge and what buttons are they going to press on their screens. It won't always be that way, but it's kind of the same thing. The volatility, the everything on edge with every statement from one group of policymakers to the other. There used to be a time that nobody cared what the Federal Reserve did. I would like to see us move back to that time. So that
you have it. It's because it's so political. It's like from both sides. So you have Trump speaking directly about the Federal Reserve and what those kind of decisions lead to. And then you have the Federal Reserve, the chairman or the Fed chair, Powell, like making actual comments during the pressers about valuations of the market, which is like, that's not last time I read the Federal Reserve mandates, that wasn't in it. I mean, it could have changed. They could have added like a subheading or something, but market valuations were not a part of their mandates. And so it's just kind of curious to me. I don't know why it has to be like that, but I mean, I think that he's trying to justify in his mind, the rate cut versus rate.
And they're really
increase.
at an inflection point, and the professionals, which they really all are at the Federal Reserve, very, very, very well educated, very purposeful and intentioned individuals. But there is a divide there at the Federal Reserve, and I think we'll see what side kind of wins this kind of divide that's there. And it's really not ideological. It comes down to whether or not you think that the growth will be deflationary or inflationary. And that's really, I think, with the potential new Fed chair coming in, takes the perspective that the productivity boom that is happening and that will continue to happen will be net deflationary. Ergo, we can get rates lower as long as the federal government keeps their deficit at 3% to GDP. So,
well, you're seeing the existing Fed, at least in their minutes, some of them are actually contemplating rate increases. We're seeing that kind of for the first time because of
I don't think that'll
inflation.
Happen. Yeah,
I don't necessarily either, but it's interesting that they're even having the conversation about that with rates where they are. And
they go back to they say, well, we got it wrong with transitory. They actually didn't. They got the timing wrong. And I mean, because inflation started going down years ago. It has gone down more, but technology is always net deflationary. Always.
They're also calculating that with data that is stale by the time they use it.
Well, they know that.
I understand that, but you have private companies like Trueflation that'll come out and say, here's the actual inflation. I think they have it under 2% at this point. With the Federal Reserve,
or something
still has it like over what they feel comfortable with, which is why they're continuing to leave the rates unchanged. And, we're seeing the expectations from our perspective based on their comments kind of getting pushed further and further back.
Yeah, there's a great book. I think it's Jeff Booth, The Price of Tomorrow. Goes into a lot of detail on it is like gravity to a lead balloon. When you have technological advancement that the rate of change is occurring faster than the rate of change of the money supply, it is deflationary. It just is. That's why it's TV like this is like $32 or something at Walmart now.
I think
right?
It's more than $32.
I mean, still, it's 132 or something. These things used to be like $5,000.
Yeah.
So it's going to be interesting, and the secret here is that nobody really ever says out loud that the system that we're in, the system that pretty much every nation on planet Earth, every nation is in, you cannot have deflation. You cannot have deflation in a debt-based system. It is orders of magnitude worse than inflation. So what that means, and why we would say that deflation would mean that you would lower rates, is because you need the currency to debase at a rate that still has a positive inflationary number, even with prices going down. Because if you deflate, then that means you owe all this debt with money that is now worth more than when you borrowed it, and that creates an issue. That was why in 2008, I remember the Federal Reserve talking very strongly about deflation. And you would think initially, well, prices going down, isn't that good? Like, negative prices. It can be in certain instances, but writ large, if you have a complete collapse of the price system, similar to what happened during the 1930s, it creates a deflationary spiral, also known as a depression. So yeah, I mean, we'll have to see. I think that regardless of, kind of the different kind of thoughts on productivity and the regime, I think that there'll be more clarity as we get near summer. And ultimately, the people that are going to benefit the most from that clarity are going to be people looking to buy homes, and kind of getting into, maybe the beginning stages of their debt cycle with their financing of cars and houses and different things. Lower rates are definitely going to help as well. Now, I don't think it does anything to credit card rates. I haven't looked recently, but last time I saw something, they were like it was shocking.
Credit cards are always kind of divorced from that. But yeah, moving on to the next mortgage rates. We're already talking about it, but 10-year falling to 4%. It's kind of starting to provide some breathing room for mortgages, auto loans, other things that are tied to that. So we're seeing lower into the sixes, I think, for mortgage rates now, which is still
the first time since 22, I believe.
Yeah, which is still a little elevated,
6.
but
yeah.
I wonder how that's going to, last week we had the housing data come out, but again, it was stale data from December, I think, or January. So more homes are being built, but yet to be determined how that affects everything.
Yeah. One of the questions that we had kind of notated here is with mortgage rates, and then just circle back on the Fed rate real quick. When you're saying they're kind of split, some raise, some not, some cut. I remember one of the conversations we had last year. No, they will cut rates this year. It is a guarantee, regardless of what is said. It 100% guarantee.
Yeah, I don't think anybody would disagree with you, but just interesting to see the dialogue there. But there's going to be a different Fed chair, so I'm not sure that it would put a lot of stock into what's being said at this point, because I think it could change. I think it will change. But
yeah, mortgage rates are down. If you're thinking about buying a house, be patient, but now could be the time to start exploring your options.
Right.
Yeah.
Let's wrap it up here. We're not going to take too much longer. I think we're coming up on the end, but
this is just part 1 of 4.
Yeah, 4-part series. Let's talk a little bit about. We want to kind of wrap these up with sort of a real world scenario kind of happenings, and we're not going to give exacts, we're not going to give descriptions, we're not going to do any of that, but we're just going to kind of lay out a principle there of something maybe we've come across the last week, a question that we've had from a client that gets us thinking, and maybe we'll get you thinking as well. But let's kind of talk about the gold trap. We talked about gold up 3% this week, actually. Really good. It's year over year return, phenomenal. It's outpacing everything. When that happens, phones start ringing. People want to buy physical gold coins. We had an example that I'll let you briefly touch on.
Yeah. It's a great example, and it's a great learning lesson and a reminder. It's been a while since I've had firsthand experience with this situation, but I have had it happen in the past. So gold can serve a very important role in your portfolio. And for whatever reason, be it through just perfect timing or inheritance, or maybe just kind of personal preference for collectibles or things that you just enjoy, people will accumulate gold. And sometimes it could be an outsized portion of their portfolio. What you have to be careful for is looking for, when you're wanting to buy gold because of, economic uncertainty, or maybe different things you're seeing on television, and arguments that can be very rational and very logical. You have to be careful about where you go to buy the gold. So I've seen a recent instance of a client kind of years ago, unknowingly purchasing on what's called numismatic value rather than the actual bullion value. The coin, yeah. So a numismatic value is it's this date at this grade, ergo it's worth this much. And it seems like a great investment, but when you get down to it, it's only valued at the bullion, at the content of the gold. So, the content of the gold itself, if you have a 1 ounce coin here and a 1 ounce coin here, and this one's from 1992 and this one's from 2002, the gold inside it doesn't care what number.
It's not like wine. It doesn't age.
It does not. It does not. It does not age. It doesn't care what the number somebody stamped on it. Now, you could, of course, find an example of some like Spanish shipwreck piece of gold from like 1790 that has some special whatever. Okay. But at the end of the day, people that dig those out of the ground are digging it out of the ground for the bullion, for the content of it. And they will be melted down and turned into gold bars, just as whatever Roman gold coins or Inca gold coins before that were melted down and turned into the Spanish gold coins.
Right.
So you have to be very careful, because I've seen some instances where people pay, generally when you're buying gold bullion to physically hold, you take a 20% round trip haircut. It's 10% above when you buy in and a 10% cut when you sell. That's cost of doing business. Okay.
Immediately you're down 20%.
And immediately down 20. So you got to hold that. And people can justify, and reasonably so, say, hey, I am going to hold this for 15 years. I want it for whatever reason, or I already have it for whatever reason. I know when I go to sell it, I'm going to pay a commission. And sometimes those spreads can get tighter depending on the market condition. But what you want to stay away from, especially if it's not really in your area of expertise, is buying on numismatic value, because that is subjective. That is very, very subjective. There may be somebody on planet Earth that wants to pay you 300% the gold value for the 1992. I don't know how you can find them. So you have to be very careful, because it's an unfortunate situation. We're having to unwind somebody that thought they were getting bullion and instead got numismatics. So be very careful, and feel free to reach out to us if you're a client and you're thinking about it. And it could be a very reasonable and rational thing for you to, maybe have some physical pieces of something that you enjoy, that you like. Just call us and reach out, and we'll give you our opinion. And we're pretty well versed in how that marketplace works. And then if you're just listening to this for the first time and it's something you've done or something you're thinking about, we'll give you a free consultation, at least talk you through it, because you can have the exact same action of buying what you think is gold at the exact same time as somebody else. And person over here can make 300% and you could lose 50. And you're both doing the same thing, but the way it's being done unknowingly is not to your benefit. So be very careful about the TV ads and the radio ads and things of that nature.
Yeah. Consult somebody. Ask a question to somebody, get some help.
That's great. Don't tell people you have gold at home either. If you do, don't.
Yeah, that's probably wise.
Don't do that.
Well, all right. Well, that's the show for this week. We will see you back here next week. End result, takeaway, economy, a little noisier than usual. Core is still solid. You can read the full breakdown of the weekly note in the email. Contact us if you want to receive that. But either way, we'll catch you next week.
Yeah. Take care.